guys, so in today's lecture we're going to be talking about the model. So elements to a model. Firstly, we want to establish a higher time frame draw on liquidity. Once we find our higher time frame liquidity draw, we want to look for PD arrays and stop runs on a lower time frame that is opposite in the direction of the higher time frame draw. So say for example, if the daily is bullish and we're going higher, we want to look for the opposite direction on the lower time frames to get in sync with PD arrays and stop runs. We use kill zones and the economic calendar to filter trade ideas, and we hunt for entry setups during established trading hours. So your established trading hours are going to be personal to you, whether you're going to be trading the London session, the New York session, or you're just going to be doing swing trading and higher time frame trading. And whatever the personal model you end up with, like, price is fractal, so you can really make a model unique to yourself. Personally, I like to trade the lower time frames. I like to be in and out, so I scalp or sometimes high frequency trade. So for me, I don't need realistically the daily time frame as my draw. I can use sometimes the 15-minute or the 1 hour as my draw on liquidity, and then I'm taking my entries and my setups on the 5-minute or the 1-minute charts. But for somebody who wants to trade, say, like the daily time frame, you can use the monthly time frame as your draw on liquidity, and then your weekly and your dailies as where you're hunting your setups. So you can be as flexible as you want with the concepts, but the most important thing is being self-aware so that you know which kind of trader that you're looking to be. So let's just get into the actual model itself, and this is the actual entry pattern. So we have our swing. Number 1, we have a stop run. Number 2, we have our break-in market structure. Number 3, we return to a fair value gap and one other PD array to make this higher probability. So in this area we can look for number 1, our fair value gap, plus an order block maybe, or a breaker, a mitigation block, an old high. Whatever you see in the charts at the time, you want to try to combine that fair value gap with something else. The more PD arrays you see nested here, the stronger that level is going to be, and the higher the probability that level will hold. We also want to look for trades that go below 50% of the expansion swing that broke market structure for higher probability trade setups. If we can't see the fair value gap on the expansion swing, we can cycle through the lower time frames until the fair value gap can be seen. So I'm just going to take you onto the daily time frame, and again, this is a crude depiction. I'm going to try to glue the concepts together in this one. We have a market profile that is bullish, and this will be the retracement swing on the daily time frame. We see price come into a daily support level, so this is a PD array. This can be, like I said, an order block, fair value gap, or something on the left hand side. Now price is currently over here. What do we do with this? So if we're assessing the daily time frame and we're at the support level, we're looking back 20 trading days and we're assessing the highs, the lows, where the liquidity is, where our fair value gaps and PD arrays are within the last 20 trading days. We can see that we have a buy side liquidity pool above this high, and we also have a fair value gap above that buy side liquidity pool within the last 20 trading days. Of course, this is just a crude example, but this is something that I would be looking at myself if I was looking at actual real charts. We have our 50% level, so our fair value gap and our buy side liquidity is in our premium range from this high to this low. So based on this, I can now assess where my draw on liquidity should be on the daily time frame. There are 2 things that I really look for when it comes to establishing the draw on liquidity. Number 1, I'm looking for liquidity above and below old highs and lows. So we have a buy side liquidity pool resting above market price, above the 50% level. Or 2, a fair value gap above or below current market price. There should have been a slash there, but it is what it is. Now, if they're both sitting above 50% of the dealing range, then this for me is going to be the highest likely draw on liquidity. 50% level is where initially I'd be aiming for, because the markets tend to, once they expand and they contract, they usually go back to the 50% area. But considering we're in a bullish market profile anyway, I'm looking for this retracement to end down here and continue higher up. Once we get to the buy side liquidity or the fair value gap, we sit on the sidelines and wait for more information. This could, of course, reverse once we get to this area anyway. So price is fractal. So we can apply this same sort of methodology to a lower time frame, maybe an hourly chart, or we could apply this to the monthly chart or the 5-minute chart. You can be as flexible as you want to be to make this model as personal as you can to yourself. But these are the two main things that I'm looking for when it comes to draw on liquidity. Is going to be an imbalance that the algorithm wants to rebalance, or a buy side liquidity or sell side liquidity pool where the algorithm seeks that liquidity. So let's take it to the hourly time frame. Now this is our same daily support level. And what do we see here? We see our initial consolidation, our first leg of distribution, second leg of distribution. So we have our market maker buy model, and we have our buy side liquidity sat above the initial consolidation and that fair value gap on the daily chart. We want to look at where we currently are at this daily support level and build ideas to see whether price wants to in fact reach higher and into our fair value gap with the buy side liquidity resting above it. This is a really good draw on liquidity because we have two things. We have our buy side liquidity and we also have a fair value gap, both above market price, when we already know that the market is underlyingly bullish and this is most likely a retracement leg. So for the market maker buy model, we're going to go down first to go up. So in the 5-minute time frame, we want to see a smaller fractal of ideally this and see where we can get in sync with the market. So this is our 5-minute time frame. This is our daily support level. Now we've moved away from the daily support and we see a consolidation. Now say this could be hypothetically the Asian range consolidation, right? What we're looking for is a stop run. We have our first stop run with our manipulation leg into a PD array in the expansion swing to the left. This could be your smaller fractal of your market maker buy model. This could be accumulation, manipulation, distribution. This could be your power of 3 after your midnight candle. So there's many variations that you can use, but they all blend in together to really do the same thing. Once we see our first stop run, we're looking for our second point, which is our break in market structure. After we see our break in market structure, we're looking to return back to a fair value gap in the expansion swing that broke market structure, and we're trying to pair that with another PD array, an old high, an order block, a breaker block. It can be anything that you see currently in the charts. Of course, there's always going to be differences and not all the PD arrays are going to be present at any one given moment. So you'll have to train your eyes to see what is available for you. We also, to make it higher probability, want to take a trade below 50% of the expansion leg. It's not always going to go below 50%, and this is going to come with experience. What you have here is gold. This fractal is a millionaire maker if you can use it within the right context. Unfortunately, understanding narrative and building contexts happens through experience, and the easiest way for me to show this is through the mentorship, which is why I'm going to be taking you through real-time charts and breaking down the narrative of how I've done it over the years and what I've learned through obviously ICT himself. So for extra confluence, we can also bring in SMT. Now say for example, this is the S&P and this is the Nasdaq. We can see that we made a lower high in the S&P and we made a lower low in the Nasdaq. So when we see this at the same time of our setup forming, this is an extra confluence that a trade is valid. A valid SMT equals higher probability. But you have to use SMT again within the narrative and the contextual framework of our trade idea.